Okay, when we look back at historical data, September usually not so friendly for investors. Our guest has more. He's an avid number cruncher. Ryan Detrick joins us now, Chief Market Strategist at Carson Group. Ryan, thanks very much for giving us the time. Happy Friday. Just remind us, September tends to be a weak month, doesn't it?
That's right. But also remind everybody it's Friday, like you said there. So happy Friday, everybody. And thank you, Andrew, for having me back on the show. So just yesterday, the S&P did hit its 20th all-time high of the year. So that's pretty good. But then, today we're selling off a little inflation. We can get into that. But looking at September, it's just important to know it is the worst month on average for the S&P 500, going back to 1950. It's the worst one. The last 10 years, it's the worst month. The last 20 years, it's the last month. In a post-election year where we are now, it's actually, I think it ranks like the 10th best month. So I call that like the third worst, right? So once again, it's historically weak. Now, let's be clear. August usually isn't all that great either. And we had a fairly solid August, all things considered. But I'd still be, my antenna's up a little bit for maybe some normal seasonal volatility. Who knows? Maybe it's starting today for all I know.
I mean, any 1 year can easily be an exception to the rule.
Sure.
What do you think, though? Do you tend to be cautious in September, Ryan? Can you generalize?
Yeah, I think you should be. I think so. We manage a lot of money at the Carson Group. We've been overweight equities, commodity for a long time talking about that. We still are. A few weeks ago, we did take a little bit of risk off. So again, why? Everyone wants to know why September. I mean, listen, talk to 10 people, get 10 answers. I think a lot of it is people get back in school. Or people go back to school. People get back to work. People get back from the Hamptons. You get volatility for whatever reason. I think it's just important to know. And one more thing to know here. I was looking at this before we came on. If you look at post-election years, like obviously S&P is going to be higher in August. Only 3 times going back to 1950s, that's a sample size of 18 times, 18 post-election years, were both August and September higher. So again, we're not calling for major sell-off or major bear market. By no means that, but S&P's up 4 months in a row off those April lows. Maybe we're due for a little seasonal weakness. We get into some of the reasons why we're still bullish. I think it's just important to have that context that after a 30% rally in the S&P, September is that kind of banana peel month. Let's just be aware of that.
Ryan, I won't bog us down, but I was just curious, where does the name September come from? Apparently, in the original Roman calendar, it was the 7th month. And so it comes from the Latin word septem. I just learned something.
It's the 9th month. That didn't even make any sense.
I know, but the old Roman calendar was the 7th.
I know, I'm teasing. Yeah.
So you reckon, the bull market continues, you remain overweight stocks?
Mm-hmm. We do. And listen, again, I always talk about maybe some near-term worries, but big picture, why are we hitting all-time highs, at least in the S&P 500? I mean, earnings came in once again way better than expected. We have profit margins hitting new cycle highs. But I'm like a big message of the markets. Like, what are we hearing from what's going on here? We're seeing leadership in the right areas. I mean, industrials, technology, financials are all leading. And a little geeky for the listeners, things like advanced decline lines, how many stocks going up versus down, continue to be very strong. This is a broad-based rally. Any weakness should be fairly contained, say 4 to 6%. And we're still quite optimistic as we head forward into the end of the year. I think higher prices the rest of this year are still likely. Maybe we got to get through September, maybe a little bit of October, but we're still pretty optimistic here, Andrew.
Staples relative to the S&P 500 have been weak. And apparently, if you're bullish, that's a good sign. What do you mean by staples? I mean, consumer grocers and stuff like that? Mm-hmm.
Exactly. So staples are more defensive areas, right? Toothpaste and toilet paper and the boring stuff that tends to do well when bad stuff is happening. So on a relative basis versus the overall S&P 500, that is hitting new lows. Okay, and that's one I followed for a long time. If we start to see leadership out of staples, or at least strength out of staples, maybe it's a warning sign. We're not seeing that. But you look at like staples versus consumer discretionary. Again, a relative basis, consumer discretionary is hitting like new highs this cycle right now. So again, that's the message of the market, Andrew, that's telling us what my opinion is still a healthy one. Now, one more thing I want to point out here before we leave. A week ago today, had a big rally in the S&P 500. The Fed turned more dovish. I know lots of people talked about that. We had a 90-90 day, meaning 90% of the stocks in the S&P, 90% of the stocks on the New York Stock Exchange, were higher, and 90% of the volume. Extremely rare, okay? Last time we saw that's coming off the April lows and off the COVID lows before that. When we look at that, though, Andrew, happened 12 other times. A year later, S&P up 11 of them, up 23% on average. What I'm saying, this strength we've seen starting last Friday, that's another bullish signal that 6 months from now, a year from now, we're pretty optimistic stocks are still the place you want to be.
Yeah, just looking at Walmart. I mean, it hasn't been terrible this year. It's up about 7%, but it's lagging the market. That'd be a classic staple, I guess.
And that's what you want. I mean, yeah, they're up. Listen, all 11 sectors are up on the year for the S&P 500. That's fine. Certain ones lead and certain ones lag. You just want to see those more defensive, low volatility staples areas lagging, and that's clearly what we're seeing as we just talked about.
I think we've touched on this theme with you before, but say the Fed does cut next month. Yeah. Cuts when the equity market's near all-time highs have traditionally been a really good signal.
Yeah, I think probably a year ago, I was on with you, we probably talked about this because the Fed cut with the market near all-time highs last September. We found 20 times the Fed cut interest rates with the S&P within 2% of an all-time high. So that's right about an all-time high. All the listeners need to know, 1 year later, higher, 20 out of 20 times. And we're probably going to have some more positive returns from some of the cuts we saw last year. Now, one other thing to kind of stack on top of this, the Fed obviously cut in December of last year, probably going to cut in December of last year. Now we're going to cut in September. So that's 9 months. It's a nice pause in between cuts. I found 11 other times they went between 5 months and a year of pausing in between cuts. What happens next? Higher a year later, 10 out of those 11, and up like 14 or 15% on average. So a pause and a cut like we're about to probably see, Andrew, it's just one more building block to why we're still optimistic this bull market's alive and well.
Ryan, give us your final thoughts on AI. Massive investment boom, to put it mildly. Is it overdone? Do you think the CapEx here?
No, not yet. Doesn't seem like it. You know, every time we hear a company, they're spending more and more. We just saw what NVIDIA had to say about AI. I mean, listen, those stocks have done well, but if you look at the earnings growth that we've seen from those companies, it's justified. So the spending's still there. And one more thing, I know we're at the end. Just yesterday, GDP was revised higher in the United States the second quarter because consumption was a tad better, but AI investment continues to, I don't surprise everybody, but continue to come in better than expected. And that's a driver why we do still think technology is an area you want to be, along with industrials and financials, the cyclical areas of the economy that'll do well if the economy does well.
We'd better leave it there. Ryan, thank you so much.
Thank you.
Ryan Detrick, Chief Market Strategist at Carson Group.